For years, I think a lot of Australians have looked at investment property through the wrong lens. The conversation was always about tax. How much negative gearing will I get? What's the depreciation? What tax refund will I receive? Now, don't get me wrong, those things certainly have helped, but they were never supposed to be the reason you bought an investment property. And after the recent federal budget changes, they're becoming even less relevant. Whether you agree with the policy changes or not doesn't really matter. The reality is we're now operating in a completely different investment environment. The margin for error has become much smaller. Buying the wrong property today could cost you significantly more than it did a few years ago. So in this video, I want to walk you through the exact 7-step framework I believe every investor should follow in a post-budget environment. Because today more than ever, your property needs to stand on its own 2 feet. So let's get into it. Step 1, understand your goal. The biggest mistake I see investors make is they start with the suburb. They jump online and ask, where should I buy? I actually think that's the wrong question. The first question should be, what am I trying to achieve? Because property isn't the goal. Property is simply the vehicle. Maybe your goal is to retire 10 years early. Maybe it's replacing your income with passive income. Maybe it's building enough equity to help your children one day. Maybe it's reducing tax. Maybe it's creating wealth inside super. These are all perfectly valid goals, but every single one of those goals requires a different strategy. If you don't know where you're trying to go, how can you possibly know which vehicle will get you there? That's why I generally encourage people to begin by speaking with a financial planner. A good financial planner doesn't tell you to buy a property. They help determine whether property actually fits within your overall financial plan. Because if the goal isn't clear, nothing else matters. Step 2, build the right strategy. Once you've identified your goal, now it's time to build the strategy. And this is where I think the federal budget changes become really important. Historically, investors could sometimes get away with buying a property that had fairly poor cash flow. Now you might ask why, and this is because negative gearing helped soften the holding costs. Today, that safety net has become much smaller, which means your strategy has to become stronger. Are you chasing maximum capital growth, balanced growth in income, strong cash flow, debt reduction, portfolio expansion? There isn't one correct answer, but there is a strategy that's right for your circumstances. Property should support your financial plan, not become your financial plan. Step 3, get the ownership structure right. Once your strategy is clear, now you can decide how to own property. Should it be in your own name, joint names, via a trust, in a company, self-managed super fund? There's no universally perfect ownership structure. Every entity has different tax consequences, different lending considerations, different estate planning outcomes, different asset protection implications. The biggest mistake I see is people asking Facebook groups, what entity should I buy in? The answer is always going to be, it depends. This is accountant territory, not social media, not YouTube, not your mate at the barbecue. A good accountant will understand your strategy and recommend the ownership structure that supports it. Step 4, choose the right market. Now comes the part that everyone wants to talk about. Where should I buy? Personally, I don't choose markets based on headlines. I don't chase hotspots. I don't buy because someone on TikTok said a suburb is going to double. Instead, I look at leading indicators, because leading indicators often tell us where a market is heading before prices start moving. I'm looking at things like population growth, employment, infrastructure investment, vacancy rates, housing supply, building approvals, migration numbers, rental demand, affordability, owner-occupier demand. It's a combination of dozens of different data points. No one single metric tells the whole story. But when enough of those indicators begin pointing in the same direction, that's when I become interested. Buying the right property starts with choosing the right market. Step 5 is careful property selection. Now, here's something most people overlook. Buying in the right city doesn't automatically mean you've bought the right property. You can absolutely buy the worst property in the best suburb. I've seen people buy high-rise apartments with hundreds of identical competitors, properties with structural defects, flood-affected homes, poor floor plans, tiny land content, oversupplied estates, all just because someone told them the suburb was good. That's not investing, that's gambling. When I assess property, I'm looking for what's called a fit-for-purpose asset, something that appeals to owner-occupiers, good land component, functional design, scarcity, limited competition, quality construction, strong rental appeal. The suburb gets you interested. The property is what ultimately creates wealth. Step 6, Cash flow analysis and due diligence. If there's one thing that's become significantly more important after the budget, it's cash flow. In my opinion, cash flow should now be front and center. Ask yourself, can I comfortably afford to hold this property for the long term? What happens if interest rates stay higher for longer? What happens if the hot water system fails or the air conditioner dies or I have a vacancy between tenants? Too many investors only ask whether the bank will lend them the money. The better question is, can I comfortably hold this property for the next 10 years? Then comes the due diligence. This is where you protect yourself from expensive mistakes. That means building and pest inspections, flood mapping, bushfire overlays, crime stats, council zoning, planning overlays, easements, rental appraisals, property manager inspections, insurance costs, body corporate records if applicable. Every one of those checks reduces risk. Skipping due diligence to save a few $100s could cost you tens of thousands of dollars later. This is also where your professional team becomes incredibly important. A mortgage broker, a conveyancer, a building inspector, a property manager, potentially specialist trades. Each plays an important role in helping you make an informed decision. Step 7, the annual review. The biggest mistake investors make is thinking the job is done once settlement occurs. Actually, that's where investing really begins. Every year you should be reviewing your portfolio. Ask yourself, is this property still performing? Can I refinance? Can I increase the rent? Should I renovate? Has equity increased enough to purchase another? Has my personal situation changed? Should my strategy change? The best investors aren't constantly buying, they're constantly reviewing. Property is a long-term game, and like any successful long-term strategy, it requires regular maintenance. Now, bringing it all together, when you step back and look at these 7 steps, you'll notice something interesting. Not one of them talks about tax, and that's intentional, because great property investing has never been about chasing tax deductions. Great investing starts with understanding your goals, building the right strategy, choosing the correct ownership structure, selecting markets using data, not headlines, buying quality, fit for purpose assets, making sure the numbers stack up from a cash flow perspective, completing thorough due diligence, and reviewing your portfolio regularly. That's how long-term wealth is built, not through speculation, not through luck, and certainly not by relying on tax concessions to make a bad investment look like a good one. And if the federal budget has taught investors anything, it's this: your property has to stand on its own merits. Cash flow matters now more than ever. Holding costs matter. Due diligence matter. Cash flow matters more than ever. Holding costs matter more than ever. Due diligence matters more than ever. And having the right team around you matters more than ever. Whether that's a financial planner helping you define your goals, an accountant helping you choose the right ownership structure, a mortgage broker helping you understand your borrowing capacity, a property manager assessing rental demand, or an investment property advisor helping you identify investment grade opportunities. Every professional has a role to play. No one person has all the answers. Building wealth through property is a team sport. Now, if you found this video helpful, I'd really appreciate it if you gave it a like and subscribe to the channel, because I post regular videos breaking down Australian property markets, government policy, and investment strategies based on data, not headlines. So thank you very much for watching, and I'll see you in the next video.